Uh, this is part 2 of the video. So once we've, again, understood what we're trying to do, we're trying to buy this company so we can change the strategy. All right. Uh, we're going to go through first in this video, we're going to first go through how you just measure the pure economics, the economics of how much we're getting, what the value of this synergy is, whether it's from uh, being able to cut salaries, whether it's being able to increase your revenues. How are you going to do this? Okay, and again, I talk about some synergies you can be maybe almost risk-free. Some synergies might be extremely risky, and you should apply probability analysis. You should treat them like a startup company. And for a startup company, you have to have a proof of concept. And once you have a proof of concept, maybe you want a very, very high return, because even after you have a proof of concept, half of them will work and half of them won't work. Okay, and that's a very, very different kind of valuation than our boring old company where we've got a whole bunch of historic cash flows and we're just making beer over and over again. We've made beer for 50 years and or more, and we're just continuing to make it. It's a completely different thing. Now, what I did is, so I put a little section divider. Now, I don't know if I don't even know if I have this right. I just, in the generic macros, I have a little, oh, come on, F2. You can use this upper and things. This is if it's, or you can use this mid and sell and find name and change all of this stuff. I just copy that formula. Okay, so let's go to the, I put a whack here just because when we were going through this in the class, we were talking about it. And when you have a analysis like this, we can start with this little case study that I started to show. This little case study had some operating and maintenance expenses, and you save 3%. And of course, we put a little spinner box that you can look at elsewhere. I'm not going to start wasting a lot of time on spinner boxes or anything else. Uh, and then we put a tax rate in, and we put a growth rate. And just a minute. Now, when we do this analysis, we want to compare the value of the synergy, and that synergy could last forever. When you really think about it, if you can cut out the CFO, you cut them out forever. Their salary is gone forever. That's a perpetuity. And you can even say, well, that CFO, she or he would have earned a salary, and that salary would have gone up with inflation. So you can even put a growth rate in. And so what you do is you eventually get the value of the synergies. Now, that's the value of changing the company. And then you compare that value to how much you pay, what's the additional amount you pay for the company. And now, when you really think about this and you think hard about this, you understand that that premium you pay, in this case, I'm using that little case I introduced in the last in the last video. And that case, let me see. Yes, and that case up here, this was this case that said, okay, we're going to get an NPV of synergies of between 1.5 billion and 3 billion. They applied a discount rate that is totally meaningless and shows you how people don't think. It really does show you how people don't think. They just took the flat kind of amount and divided it. They didn't put a growth rate in. They didn't put a tax rate in. They didn't recognize that some synergies could be risky and some could be a lot less risky and so forth. But when you put the number of shares the company had and you multiply that by the 37% premium and multiplied by the number of shares, you get a total consideration. A consideration, of course, is shouldn't keep saying of course, the consideration is the amount you pay for the equity of a company. And then the premium is the amount on top of the current capitalization, the current market capitalization. So we have 2.14 billion in a simple calculation of the premium. And if you believe that, if you believe this value of the synergies, well, I suppose the high side of the synergies might be something like this. But when they computed the synergies, it's very, very clear that they did not take an after-tax calculation of the synergies. And just like any other cash flow, this valuation of a synergy, it starts with the Ebitda. It starts with those operation and maintenance expenses. And I put the 3%, we can put in a 5%, 4%, and we can put in a different growth rate on those, okay? And when you put a different growth rate in, you should, if your Ebitda is going to increase because you eliminated that double CFO salary or double the IT department or double the oh no, there's some noise. If you put this additional value in, you better pay taxes. That's going to increase your taxable income. And at that time, their tax rate was about 40%. And once you consider the tax rates, then the value of the synergies is going to be a lot less. So right off the front, the question you should ask is, why do you not, in this case, let's say after tax, the value of the synergies is, I don't know, let's say it's 60% of that. So it's somewhere between this, and you're paying a whole lot more premium. You know what you could do if you were the chairman of this or in charge of this Exelon company? It would be a lot better if you just told your investors, instead of paying all this extra amount for this company, why don't you just, we're going to give you some good advice. We're going to tell you, if we think this company is undervalued, you go ahead and buy those shares. We don't want to buy those shares for you, because if we buy those shares for you and pay all this really, really high additional premium for those shares, and we can't get that back through synergies, we're doing a disservice to our own investors. It's as simple as that. It has nothing fancy about valuation or anything else. It's just incrementally the value of the premium, which is after tax. Anytime you have a stock price or a market capitalization, that's from the income. That value comes from income, and income comes from after tax, after you pay corporate taxes. And when you do your analysis of the synergies, you better use exactly the same kind of approach. And of course, you also should reflect an appropriate discount rate. So this is just a review. Now, once we computed this valuation, we said, okay, well, we could put a terminal value using the simplistic and generally inappropriate Gordon's method, even though I mentioned in part one of this video that there were these people from Switzerland who surveyed the valuation techniques of investors and found that most people use this Gordon method. And maybe they use a multiple method. So in the Gordon's method, we just apply this formula and we say, for 8 years, we're going to have a growth rate. For 8 years, we're going to have a growth rate in our synergies of 3%. And at the 8th year, at the end of the 8th year, we're going to start with really the next year. That's why we put times 1 plus g. So we start with this, we multiply it to get it to the next year, and once we multiply it to get to the next year, excuse me, there's a little bug on my computer. Once we get to the next year, we're going to divide it by the cost of capital whatever discount rate we use, and we should use a different discount rate. I'm repeating myself so much, you must be getting so sick of me. We use a different discount rate depending on the risk of the synergies. And these have nothing to do with the whack of the company or anything else. If your only synergy is firing the CFO and you know you're going to fire him for absolute certain, why wouldn't you use a very, very low discount rate? If you have some crazy speculation in the synergies, you should use a much higher discount rate. Now, when you get to this last year, you could also apply an EV to Ebitda. That would be a typical kind of thing you might do. And when you do this, where did I put my, just a minute. I didn't put my data table in here. We could do, oh yes, I did. We could do a classic, just like any other valuation. So I was just using this to show you a valuation. We can take this present value of all the cash flow savings we're getting over the explicit period and use exactly the same sort of techniques we use for anything else. There's nothing magic here. Absolutely nothing magic. And we could get a net synergy value using our growth rate method. And then when we do that, we might do a sensitivity for different growth. Now, when you do this, you're going to take and select the data table. And when you select the data table, you'll go to what if analysis and data table, and that row input will be the growth rate. And you have to do this. This is what I moan about so much. It has to be the growth rate should be the terminal growth rate, and the WACC is the discount rate. And then you get your data table, and I had this. I had the option set to automatic without data tables. I suppose I'll put it on automatic for just a minute, which will slow things down. You can kind of see it happening. And when you do this, I don't care if it's this simplistic of evaluation or something else. When we do this, we get this enormous range of values, depending on what the discount rate is and what the growth rate is. We get the 6.4 versus 1.9. And if we put let's put a longer explicit period, maybe. And let's do it with a longer explicit period. So what that does is you say, oh, I'm so smart, I'm going to be able to predict what's happening for the next 18 years, and then we'll look at our data table, and in our data table, we'll if I can find it here in just a minute. In our data table now, we get the same sort. Is that right? Function. Okay, so now let's work on the next method. I'm going to show you how to work through this method where we compute the accretion and dilution. I don't know why I have to press F2 on that, by the way. When we compute this accretion and dilution, we're going to make a little forecast. And we're going to make a forecast of an acquiring company. And now I'm going to then make a forecast of a target company. Okay. And the forecast I'm going to use is not some internally biased forecast. It's not some forecast that I have made to fiddle around with things, to manipulate my synergy estimate or anything else. The forecast I'm going to make is from public sources. Now, when I have my class, what I will do is I will go, and I have wasted so much time on this, never ever sold it, never ever done anything really with it. I made this database that I started working ages ago and I make this a little database, and this one was for, I think this is this one. I made it for, I called it Facebook and Microsoft. And at first I was going to have, because of all of this, I don't know, this video will be out of date probably soon. But there's this business of TikTok and Microsoft buying each other and all that stuff. And I have spent so much time trying to, to, if I could get one word out, I'd be so happy. Trying to download data. And I downloaded some data. I finally said, okay, let's look at Microsoft, but not look at Microsoft buying Facebook or anything like that. Let's just look at Microsoft. And here's Microsoft. They've been growing their Ebitda consistently. Their earnings have been growing. And then, and we can look at their basic earnings. We can look at their PE ratio. And down here, we can look at their EV to Ebitda ratio. I'm so proud of all of this stuff. And it kind of works. And it downloads pretty easily and all that. I think what happened is there was a low estimate maybe of Ebitda, so the EV to Ebitda ratio went way up, and here's their PE ratio, and then we'll look, instead of just at Microsoft, we'll have Microsoft by IBM. I remember that, I'm not going to look at this. I remember my first IBM laptop. Oh my gosh, it was gigantic. It had this tiny little screen. You don't care about any of that. Okay, and then we can look at what's happened to IBM's earnings, and they've been kind of not that great. And Ebitda we can look at, and we can look at the return on invested capital and everything else. And so everything I do is kind of either from a free cash flow or core company analysis. This has just been totally flat. Maybe they've been buying a little bit of shares back and they expect this to increase. And then you can go over here, you can get from MarketWatch or Yahoo, you can get the current estimate and the next year's fiscal estimate of the earnings per share. And then you can also get the expected 5-year growth. So the expected 5-year growth for IBM was this, and the expected 5-year growth for Microsoft was that. So I'm going to close this file, which is a gigantic file. If you open this file, be very careful. I sometimes do something extremely bad. I change the formulas to manual and don't change it back when you just close the file. Okay, so here Microsoft is going to have an increase in earnings of 15%. So we can get a forecast of Microsoft. And then we can get a forecast of IBM. Here's their earnings and see what they have. That's pretty objective, nothing fancy. I didn't swiddle around with anything else. And we also have how many shares they have outstanding and Microsoft's share price. We have the shares outstanding for IBM and their share price. And then what we can do is we can take the market capitalization of this should be, I hope, of our target company. So I better put market capital of our target. And then we can put these earnings together eventually. We multiply it by the number of shares, and we can either choose to put synergies in or not synergies in. So we're going to judge this time. We have no WACC. Isn't that wonderful? We didn't have to make any assumption about WACC. We didn't have to make any assumption about synergies and taking over the company. All we're going to do is take and put these two companies together. And whenever we do this, this is a little bit of an introduction. Whenever we do this, we need to set up some transaction assumptions. Okay, and the primary thing you're always going to do in any kind of analysis whatsoever is you're going to make a growth. I mean, you're going to make a cash forecast. You're going to make a cash flow forecast. And then let's pay a 25% premium for IBM. Okay, so we're going to pay a premium. And now what should happen is that when we pay this premium, we should end up with the result that this is an idiotic, stupid thing to do. because I need to add something like this, I'll put Synergies as percent of target income, something like that. And I'm just going to make it, you could make any kind, but I'm going to make sure that that's 0, Shift Control P. Okay? Now, we're not using this PE ratio at all. But when we measure the stock price of Microsoft and the stock price of IBM, we get a very, very different PE ratio. So we put the two companies together. We put the two companies together, and we have. We better. Okay. We put the two companies together, and we put the shares over here. Perhaps when you do this, let me put shares, and I'm going to put the shares up at the top here, and perhaps this is income, with not income per share. This is purely income, and I hope up here that I didn't work to. This was the earnings per share. So all we do is we take the target company, and we're just going to multiply this shares times income. That's how much they get, and we do the same thing for our company, Microsoft. Okay, and then we have the consolidated income, the consolidated earnings. Now, we make some transaction assumptions, and in our transaction assumptions, we're going to do a share exchange. And if we take the current share price, of our target company and divide it by our acquiring company, this says that, look, as a shareholder of IBM, I can either get my one share that's worth 125, or I could take that one share and divide it by, or multiply it by 0.58, and I get the exact same value of Microsoft. So what we're going to do is we're going to say, no, I'm going to give you a lot more shares of Microsoft than, I'm sorry, yes, you're going to get 0.74. And that is simply the 25% times the 1.25. First time I saw this, I thought, oh, this is so cool. This is just kind of magic. And then I can say, well, let's take the IBM shares, multiply that by our premium, our exchange rate, and we get 635 shares. Okay, and once we do that, so then we get a consolidated amount of shares. I hope I put the new Microsoft shares. I think I should put the total shares here. And what I'm trying to tell you, and I'm not doing a very good job of it, total shares after transaction. Okay, and I'll even put total Microsoft. And we take the new shares that we got, plus we take the initial shares that they began with. That's our new shares. Maybe I'll make the double underline on that one. That's what we're doing. We're working through how much we're paying for the company and where we're getting the money. That's always a step in doing these in these M&As. It's always a step, whether it's a simple thing like this or a complicated thing. So then we're just about finished, because once we have the number of shares, which we held constant for both companies, then we just take the consolidated earnings and we divide our consolidated earnings by the consolidated number of shares, and we get the consolidated EPS, and then we put the acquiring EPS, that was Microsoft. and we can see what the result is. And what happened is every single time, remember this had no synergies, and when let's make a little graph of this. And when you make a graph, you want to leave this blank, of course, and you want to put in the year, okay? And then you start with this blank one, and then you press, I've got to be careful, we're going to press alternate and F1, and let's put the graph kind of down here, and then we have an accretion. And even though that accretion is perhaps I'll do this. Let's put this accretion here. And I want to make one more thing because perhaps this is the most important, okay? Shift control, whatever. Okay. Now, when we do this, we can press shift function. You have to press this function key. We can put our accretion and dilution. Notice something really important. The accretion and dilution is going down. We can also then say, oh, okay, let's do this really quickly. Let's put 25 here without a percent. And let's make I promised that I wouldn't do this, but I'm just doing this one single time. And let's put let's put a minimum value of 0 and a maximum value of 50%. All right, I should have turned the video off for this probably. Okay, and we'll just put some different accretion and dilutions in here. And what we can see is just how much accretion and dilution we have up here. Okay, maybe I'll put up here, let's put the premium up here. Okay. And up here. Okay. And then we can put our premium higher or lower. And eventually, if we put a high enough premium in here, we'll, oh, maybe I'll have to put more than 50% premium. We could even stop here. You can see that dilution and accretion is going down. And this is an extremely simple example. It's a very, very simple example. But it illustrates something. It illustrates what you're doing whenever you're going to make an acquisition model. Okay, number one, the advantage of this is there's no, I'm repeating myself, but there's no WACC and no terminal growth rate and all that. There's an enormous disadvantage. And this is the problem. There was a company in the 90s called, it's still around, I think it's called Tyco, and they do this silly thing where they get people paranoid and you buy all your, no, it's good stuff, whatever they do. But they started buying up companies, and they had a high PE ratio, and the only reason this whole thing works is because the PE for Microsoft is higher than the PE for IBM. Now up here, when you did your PE analysis, we understood, I hope, that the reason for a PE being higher or lower was because of growth, was because there was more potential for growth. Of course, when we had a increasing ROIC, we get a higher PE ratio. Now, this is the crazy thing that happens with all of this stuff. When we put in when we buy a company and when we buy a company like this, what happens? When we get accretion in earnings per share, guess what happens when we get accretion in earnings per share? then our PE ratio, we have higher growth in our earnings because we bought a company, we have higher growth, and then we should get an even higher PE ratio. And then we can keep buying companies with a low PE ratio and get a higher one. But that's called feeding the monster. We can almost make a picture of feeding the monster, because what happens then, eventually, can you see how this dilution is going down, and eventually it'll go negative, and over the long run, it's a silly game to play. Everybody knows that if you just buy companies without any strategic objective, you might get some of this accretion and dilution happening, and that's extremely important for investors, but it's a lot of game playing, really. Now, but before we go into all this game playing, this kind of analysis is kind of not so bad. This kind of analysis you could do with a private company as well as a listed company. And I've done these other ones before, so now I took a company that had some earnings, and we had some earnings growth going down, and we again get this from public sources, no big thing, and we have some shares, and we're a listed company. And now instead of I'm gonna put this up here, okay, and instead of doing this, I'm gonna put the transaction assumption. And we can pretend we buy, this time, we buy another company, we buy it debt-free, tax-free. I mean cash-free, okay? But this time, it's not really very different. I'm going to assume that this company earns a nice good return of 20%. That's our ROIC. And that's why when I looked at this Harvard stuff, and they never mentioned ROIC in the course. I just can't believe it. We have ROIC and growth. Those are two value drivers. And now when we do this, we need to understand what the depreciation rate is as well, because we need to understand if we have some Ebitda, what's the cash flow effect of that Ebitda going to be? So I then said, okay, let's buy this company and let's put some debt financing and some equity financing in. This is like a sources and uses of funds. It's a little sources. This is the uses of funds. And then just below that, we make a sources of funds. And then just like before, we have our own stock price. And if we issued 400 of equity, we have to indirectly or directly issue some new shares for that. We have to issue some equity for that. So we take that 400, we multiply that by our exchange rate, and then we also put in an interest rate, and I got the market capitalization for the existing company. That was less important, okay? So we work on some transaction assumptions. This is a private company, not a listed company. And then just very quickly, we need to understand if we have some depreciation, how we're going to finance the capital expenditures to replace our depreciation, and if we put a growth rate in, how we're going to finance our new investment. So I just put a little bit of I just assumed that we're going to finance, we're going to get some operating profit, and we're going to finance that with debt. And then we're going to have to pay some interest expense on the debt. I'm going through this fairly quickly. It's pretty simple, and it's not a big deal. And then what we do is we put our existing earnings exactly like we did in that very simplistic analysis with IBM and Microsoft, and then we find the new earnings, and I sure as heck hope that I put the new earnings here. That's our earnings. We put our profit after tax from our return on invested capital. Our return on invested capital, we take our investment and multiply our net investment by our return on invested capital. This was a very high return, and we subtract the interest. So this new earnings is a little bit too complicated, perhaps. Maybe I should have put the earnings from the target. Okay, so then we take our profit after tax. We should really subtract the tax effect of the interest too. Okay, I'm not even doing that. And then we get, so we get our earnings from our target. Okay, I'm leaving out taxes. Of course, you could make this much more complicated. But then we get our total earnings, including the new company. We issued some new shares, so we get our total shares just like we did before. And within minutes, we take our consolidated earnings per share, our existing earnings per share, and we can graph what the accretion or dilution is from our transaction. Now, this finally, it has something real in it. If we only earn 5%, then we get dilution. If we earn 10%, we get maybe 15%. We have to get the accretion. Okay, it depends on how much we pay for the company and what we're going to earn. Okay, and then we put if we have a lower growth rate, then we're going to get a different accretion and dilution. And we can boil our accretion and dilution down to really what the value drivers are. It comes down to this. No matter what kind of analysis we do, it comes down to this. So we've gone through two different approaches, very different approaches. We've gone through the economic value. And why do I have to do this? We get that, and then we get the accretion and dilution. And now I'm going to stop the video right now, and then we're going to make a third method, which is deriving the M&A value from an LBO analysis and an LBO model. And we'll have to use the EV to Ebitda ratio a lot. And if we don't understand what that EV to Ebitda ratio should be, and if we don't have any basis for computing the EV to Ebitda ratio other than some simplistic and kind of frankly idiotic comparable company analysis, we should really stop. And so I'm going to stop this video now and make one more, or two more actually at least.